Good morning, everybody. We're going to be speaking today about various issues that affect developers. Can I welcome you all again, everybody that has just joined. My name's Isabel D'Inverno. I'm Director of Tax here at Brodie's, and I'll be joined by Bob Langridge, partner in our corporate tax incentives team. Welcome to the seminar. We're going to be talking about various LBTT issues that affect development transactions today. Please ask questions using the Q&A function, and we'll deal with them during the webinar, or alternatively we can get in touch subsequently and deal with any questions that we don't have time to get to. So the first thing we're going to talk about is overage and LBTT. What's overage? Well, it's trying to bridge the gap between what the buyer of land thinks they ought to pay and what the seller feels they ought to get. So it's providing a way of deferring some of the consideration depending on how things turn out. So if we imagine a situation where there's a fixed purchase price of £3 million, if there can be various different types of overage, but here are some examples. So if the number of residential units for which planning permission is obtained exceeds 100, then additional consideration of 200,000 will be payable. Or if planning permission is obtained within a 10-year period, an overage payment of 5,000 per residential unit will be payable. Or a sort of further variation, a further payment equal to 50% of any profits realised by the purchaser in the event that the property is sold within 18 months of acquisition. So those are all examples of different types of overage payments. How does the LBTT treatment work? Well, it depends on whether the consideration is contingent or uncertain, and also the possibility of it being unascertained, which does generally just a question of whether it's contingent or uncertain. Future events that obviously come up are how much LBTT is payable, and can you defer payment of the LBTT until you actually have to pay this additional consideration. So looking at contingent consideration first, it's contingent if it's an amount that only has to be paid if some future event occurs or doesn't occur. And an example of that from the ones we looked at is if the number of residential units for which planning permission is obtained exceeds 100, additional consideration of 200,000 will be payable. So that's a pure contingency. Either the number of residential units for which you get planning permission exceeds 100 or it doesn't. And for LBTT purposes, you have to pay on the basis or on the assumption that the contingency will occur, i.e. you have to assume that the planning permission will be for more than 100. And in the LBTT return, you have to put the full amount of the contingent and non-contingent consideration. So in our example, it would be the fixed price of 3 million plus the 200,000. It may be possible to make a deferment application to defer payment of the LBTT on the 200,000, and we'll come to that in a minute. Uncertain consideration. If the planning permission is granted, an overage payment of 5,000 per residential unit will be payable. This is uncertain because we don't know how many units they're going to get planning permission for, and its amount per unit. So in this case, you have to do an estimate. You have to do a reasonable estimate of what this additional consideration will be. In this case, the developer who's buying the land estimates that they'll get planning for 100 units. So the overage payment's estimated as being 500,000. And that's the amount that you would put in the LBTT return. But again, there may be a possibility of making a deferment application. Sometimes the uncertain payments may be very unlikely indeed to actually crystallize and be payable. So in our example, we had 50% of any profit realized by the purchaser if the property's sold. The amount that might be payable here is uncertain. It's also contingent on the property being sold within 18 months. But it is, in the eyes of the developer, very unlikely indeed to happen, because what they want to do is get planning permission and build houses. So it's more of a non-embarrassment payment. If the developer decided to flip it on and made a profit, the seller would feel a bit stupid. So it's a non-embarrassment type payment. And a reasonable estimate of the value of this could actually be pounds nil, in which case that could be what you would put in the LBTT return, and effectively you wouldn't be paying any LBTT on this amount. But again, you can make a deferment application in relation to this. There's a difference between uncertain and contingent consideration and consideration that's just deferred. So if you have initial consideration of 2 million and 2 further payments of 1 million on the first and second anniversaries of the completion date, that's not contingent or uncertain. The amount payable is known. And you just pay LBTT on the whole of that, and there's no possibility of a deferment application. If you had something like initial consideration of 2 million and further payments of 1 million plus indexation, that's partly known and partly uncertain, because the indexation allowance element would not be certain, but the £1 million of the 2 further payments is certain. So if you wanted to do a deferment application, you would only be able to do it for the indexation part. When contingent consideration ceases or uncertain consideration becomes certain, you have to do another LBTT return and pay the additional amount or reclaim any amount overpaid. And the position's slightly different depending on whether a deferment application has been made or not, but it's certainly necessary to do additional returns once the petition's been finalised. Moving on to deferment applications, or deferral application as they're called. You can make a deferment application if the consideration is contingent or uncertain, and it will or may be paid more than 6 months after the effective date. So assuming that you're in that situation, you can make a deferment application. As we've mentioned, you can't make a deferment application if it's just deferred consideration. There's got to be an element of it, or it's got to be contingent or uncertain. And you can't defer LBTT on rent. So you can't do a deferment application relating to rent. There are regulations which set out how you apply for a deferment and what details have to be given. There's also guidance in the LBTT manual, and there's a detailed list of information that you have to supply. You have to make the application within 30 days of the effective date, and these time limits are strictly observed. But you can obviously make it in advance, although if you don't know the effective date, you have to give Revenue Scotland an estimated effective date. There is a form that has to be used, the Revenue Scotland deferral application form. Revenue Scotland actually have a limited scope for refusing a deferral application. unless there's a tax avoidance motive, which is not very likely, or if not all of the required information has been submitted, although to be fair, they would generally just ask for the additional information. But the time limits are very strictly observed. I think we've certainly had a deferment application refused on the grounds that it wasn't made in time, or we've seen that happen, but not very many, or if any, refused by Revenue Scotland. Apart from that, you get a deferral reference number, which then has to go in the return. If the deferral application has been accepted, you pay LBTT only on the initial consideration, which would be the £3 million in that example. So you include the additional contingent and estimated consideration in the return, but you have to adjust the LBTT payable, so it's just the initial amount that is shown as being payable. And you have to do a further return once it ceases to be contingent, or the uncertain part becomes certain. Is known, LBTT is payable, but only with interest from the date of the further return, and that's why it's worth doing a deferment application for that non-embarrassment type payment where you only expect it to have a value of nil. Because if you do a deferment application and it turns out that there is that kind of non-embarrassment payment payable, interest only runs from the date of the further return and not from the beginning. Other issues on overage are what happens if on up to a second buyer who buys with the overage provisions in place. So A bought land and agreed to pay overage and makes a deferment application, but then sells the land to B. It depends on how the deal's structured. If A continues to be liable to pay the overage, then A will have to pay the LBTT if and when the overage is triggered, but won't know what events are happening which might trigger it. So it may be appropriate to get an indemnity from B for the LBTT on the overage, and also requiring B to give details of events that will trigger the overage payments. But if the requirement to pay it is transferred to B, then A's requirement to pay overage will terminate, and at that stage A will do a further return saying that the overage position has been ascertained. B may be able to make a deferment application themselves. So that's it on overage. I'll pass over to Bob now to talk about subsale development relief.
Hi everyone. So first of all, I thought it'd be useful just to talk quickly through what a subsale is, why people might do one, and go through one of the more common scenarios where we see subsales used in development transactions, as well as a little bit of background to the subsale development relief that we have in Scotland, and then we can talk through the relief conditions themselves. Broadly, a subsale is when a party, B, agrees to buy land from A, and before they complete that purchase, they contract to sell the land on to C, and then in an ideal world, the purchase from A to B and the sale from B to C complete both at the same time. There are a number of reasons why people will do these. The most common two are either because they have spotted an opportunity to contract for a valuable property and then make a profit flipping it on to a third party, or more commonly as part of the structuring of a wider development. And if you think about what Isabel has been talking about, that is normally the kind of contractual relationship that you will have between a landowner and a developer. So a developer will contract with a landowner to acquire a site. Then they will go out and find a funder. This is someone who's actually going to pay for the development to take place. One form of development kind of structuring is what's called a forward fund. And in a forward fund, what happens is on to the funder. So they will be selling the bare site usually onto the funder. And at the same time, they will be entering into a development funding agreement with the funder or the investor that will govern how the property is built out. Once those contracts are in place, the developer will trigger the contract with the landowner. So they will acquire the land from the landowner, and then they will immediately sell it on to the funder, at which point the landowner will drop out of the picture. And because the contracts have completed, we're now left with the development funding agreement, under which the developer will provide development services to the funder to actually construct the relevant building or buildings on the land that the funder now owns. And in these circumstances, we often structure this as a subsale, so that both sale and purchase by the developer take place on the same day. Now, originally, under LBTT, we didn't have any form of relief for subsales whatsoever. And this is in stark contrast to the position in England and Wales as it was when LBTT was introduced, where there are long-standing reliefs for subsales. The reliefs in SDLT are quite generous and quite broad, but by contrast, the relief in Scotland is quite restricted. We didn't have a relief originally because there were concerns that subsales were used as a vehicle for tax avoidance. There were a number of representations by the legal industry and the real estate industry about the need for a subsale development relief, because of the impact this would have on the development industry, because of structures that they use like forward funding. So we now have a very restricted form of relief, which is the subsale development relief itself. The conditions for the relief are quite numerous, and they are conditions which on the face of them might appear simple, but can actually contain a number of little elephant traps for the unwary. The first point to note about the relief is that it's only the first buyer in a chain that can claim the relief. It is, in theory, possible to have much longer chains if we just flip back a slide. In this chain, you can see that we have 3 purchasers in our chain. We've got B buying from A, C buying from B, and D buying from C. Now, in England, that series of transactions, both B and C could potentially qualify for relief. In Scotland, in development or subsale development relief, it's only B who can qualify. It's only the first buyer in the chain who can claim the relief. If we flip back to the conditions slide, the next condition is that all of the contracts for the land purchase and sale must be entered into in the correct order. And that is that the contract between A and B has to be entered into before the contract between B and C. This is an area where it's quite easy to come unstuck. 2 ways people can come unstuck here is, first of all, people can get confused and assume that conditionality is relevant in contracts, and it isn't. Sometimes people will enter into a contract between B and C that is conditional on getting an A to B contract. That fails the test here because there's no requirement for unconditional contracts. Any contracts will do. The other way that this condition can be breached is if people mix and match between options and ordinary contracts. Now, a development subsale can work if it is options for both, provided that the options are exercised in the correct order, or if it is contracts between B and C and A and B that are entered into the right order. But sometimes we find people putting in place an option between A and B and then a contract between B and C. That won't work because there isn't the right kind of contract between A and B until that option is exercised. The next condition that can trip people up is that, in effect, A, the first person in our chain has to own the land at the time they contract with B. This isn't exactly what it says in the legislation, but it is the net effect. Next important point is that the chain of contracts between A, B, and C must all complete or be substantially performed on the same date. There are a couple of little wrinkles in the rules around here. Those of you who like to listen to tax lawyers complaining will know that we have a hated section in the LBTT Act called Section 14(1)(c), which says that if you have contracted to buy a piece of land and you contract to sell it on, then that contract to sell it on substantially performs your contract to buy, and you become liable to tax at that point. Helpfully, the subsale legislation goes on to say that if you have a qualifying subsale, so if you're within the ambit of subsale development relief, you don't treat the first contract as being substantially performed. There's a second helpful little wrinkle in here, which says that if C, the person buying from B who will claim the relief, contracts to sell the land on again, that subsale by C, A, it won't qualify for the relief, but B, it won't prevent the middleman B from qualifying for the relief either. As I mentioned before, no one after B in the chain can claim the relief, even if they do subsell. I think there is sometimes a bit of confusion around this in practice. Sometimes we see people putting in clauses that will say that other parties won't claim subsale development relief. So I have seen transactions where we have a chain that goes A, B, C, D, and C tries to impose a clause on B that says B will not claim subsale development relief, with the intention that C can claim it because B hasn't. And that is wrong-headed, because that's just not how the relief operates. It is literally only B who can claim it. C can't claim it irrespective of what B does. The next important point is that the end purchaser, the person who winds up with the land after the subsales have completed, must carry out significant development works within 5 years of the transactions taking place. Otherwise, the relief will be clawed back. That is quite unusual because here B's relief is utterly contingent ultimately on what C or other parties do with the land after B has sold it. Now, in our forward funded example, that is maybe not too much of an issue in practice, because B is being hired as the developer after the subsales complete to go in and build out the land. But you do see situations where the party making the subsale is not going to be engaged as the developer, so doesn't control the development. In all of these circumstances, you therefore want to think in your contracts about how you reinforce B's position. The normal way of doing this is by putting some form of indemnity in. And I would just advise everyone to think very carefully about what is appropriate, depending on the fact pattern in terms of the indemnity you're seeking. If we have a situation where B has no further engagement in the site, then you might want a very wide indemnity for failure to complete significant development. If we have a forward fund scenario, you might want to restrict the indemnity to situations where the development doesn't complete within a 5-year timescale because of delays occasioned by the funder. Next, another restriction that isn't there in the face of the legislation, it's a restriction by omission rather than commission, and that is that subsale development relief does not apply to assignations of contract. It only applies to what you might think of as back-to-back sales. So again, in SDLT, you can claim subsale relief or pre-completion transaction relief on an assignation of a contract to buy, as well as a sort of proper subsale. In Scotland, the availability of the relief is only on the proper subsale itself. An assignation of a contract does not work, although there are cases where it is possible to work around that. Also, just another restriction to be aware of, if you are only subselling on part of the land you are buying and not all of it, then the relief works slightly differently. It isn't, in the case of a partial subsale, a 100% relief, it is a partial relief. And the relief operates by reducing the chargeable consideration for the purchase on which B pays tax. And the way it reduces it is by apportioning it on a just and reasonable basis between the land that B is retaining and the land that it is subselling on, and removing the amount apportioned to the subsold land from the calculation. On the next slide, here's just a quick sort of summary of how the relief operates. You can see only B here can claim it. Ultimately, in this example, B's relief depends on D developing the land. Both C and D will pay LBTT unless they can claim other reliefs. And here we'd expect an indemnity between B and C. And again, C might want to get a cross indemnity from D in these cases. Now, because we mentioned forward funding and a scenario where we will split out the purchase contract and a development agreement, I'm going to pass you back to Isabel, who's going to talk about a very relevant case, which is the Prudential case, which talks about how the LBTT works in those circumstances.
Thanks, Bob. So Prudential planning, as it's referred to, why is it called Prudential planning? Well, because the original case that it started from involved the sale of land to Prudential and a separate contract for offices to be built on the land after it was transferred to Prudential. And the question was, how much, it was a stamp duty case, how much stamp duty should be paid? Should it be paid on just the land price, or should it be paid on the land price and the office building? Because in reality, what Prudential was acquiring was a finished office on the land. And the case, the outcome of the case was that stamp duty was payable on just the price for the land, including any works carried out up to the date of transfer, and not on the construction costs. So the outcome of the case meant that there was a considerable saving for Prudential in structuring things in this way. When SDLT, sorry, if we just go back a moment, when SDLT was introduced, HMRC eventually agreed that the decision in the Prudential case would apply for SDLT in the same way as it did for stamp duty. And moving on, LBTT follows the same route. So this is an extract from the LBTT Technical Bulletin #1, which is confirming that Revenue Scotland accept the principles established in Prudential apply to LBTT. So Revenue Scotland will consider, and we have to consider, whether a contract for the sale of land and a contract for building services is the sale of land with completed buildings, or whether it's two separate things, a sale of land on the one hand and an agreement for the building of the buildings on the other. And they say generally, unless the two contracts are so interrelated that the default of one will prevent completion of the other, LBTT is only chargeable on the consideration attributable to the land. If the two transactions are part of the same bargain, then that doesn't prevent the prudential treatment from applying, but there has to be a just and reasonable apportionment between the purchase price for the land and the amount that's being paid under the development agreement or the building contract. So the prudential approach is very frequently encountered in commercial transactions like the forward funding that Bob was mentioning, but it can also be used for construction of residential property if the amounts involved are significant. And we do see it in residential property transactions, but we see it an awful lot in forward funding deals. But it's obviously quite a different position in terms of risk and all the rest of it for the funder at the end of the chain, because they are buying the land and they don't get to sort of change their mind about that depending on the outcome of the building contract. So what do you have to do to achieve the prudential treatment? Well, you need to have separate contracts for the sale of the land and the construction of the buildings. You can't really have them in the same contract. It may be possible to try and achieve that if you had to, but really the general approach is to have separate contracts. And the land sale actually has to complete at the outset. It's not just a contract, it has to complete. So the forward funder has to buy the land at the outset. And LBTT is payable on the buildings that are on the land at the time of the transfer. So depending on what's been going on before the land is sold on, there may be LBTT on more than just the bare land. And sometimes that can be the case if you're trying to not sell the buildings until you've achieved, for example, a residential property under construction under the sort of golden brick arrangements. So in those sorts of situations, the LBTT will be payable on the golden brick works, i.e. how much has to be done in order to get the sort of operations up to being a building, a residential building in the course of construction. So we've mentioned a just and reasonable apportionment between the land price and the construction works. That generally is not something that the revenue tax authorities actually look into or challenge, but it is something to bear in mind, that you need to be able to justify the way that things have been split. You can make the building contract or development agreement conditional on the buyer acquiring the land. That doesn't cause a problem, but there are a few things that can cause problems, as we'll see in the next slide. So any provision whereby the land can be returned to the seller if there's an issue with the building contract is going to cause a problem, because that makes it look as if what the buyer is actually buying is a finished building. So if the land can go back, or if the buyer can require the seller to buy back the land, those will all throw a question mark over the prudential treatment. And obviously there could be a huge impact for the buyer if the prudential treatment isn't available, because they'll be paying LBTT on the aggregate consideration. Similarly, a price reduction if the seller doesn't perform under the building contract. So these are all things which kind of make the building contract and the land sale too interconnected. It may be possible to delay payment under the land contract, but you can't have something which means the land contract, the land sale can unravel. What if the seller or the developer takes a security over the land to secure payments of sums due under the building contract? Well, that's a more complicated question, and it may be possible to do that, but it certainly does cause a bit of anxiety about the prudential treatment, so it may not be acceptable. Loans, on the other hand, by the buyer to the seller would probably be acceptable. So the prudential requirements are extremely important to ensure that the forward funder or any other party trying to rely on it only pays LBTT on the price for the land and any buildings on the land at the time of the transfer. It's better to err on the side of caution to make sure that there is no risk to the prudential treatment. There are some other reliefs which might be in point, particularly in relation to house builders, and I'll hand back to Bob to deal with those.
Hello again. So I'm going to very quickly rattle through these. The sort of notional transactions that have been going on in the backgrounds of our minds as we work through these are kind of reaching their culmination. So the buildings, in this case houses, that we've been dealing with have been built, and the developer or the investor is now ready to sell them. And there are a couple of reliefs that may sometimes be in point when a house builder is selling newly built houses. The reliefs here are available to house building companies and also to what are called property trading companies, more on them in a minute, when they are taking ownership of someone's old house in part exchange for the acquisition of a new build, or in the case of property trading companies, when they are stepping into a broken transaction chain to allow purchases to complete. If we go to the next slide and look at house building companies first, this is probably the simplest one. The conditions for this relief are relatively straightforward. In order to get a full relief from LBTT and the ADS, a house building company must be acquiring an old dwelling from someone, and they must be acquiring that old dwelling in part or full exchanged for a new dwelling that has been built or converted from something non-residential by the house building company. New here basically means not previously occupied in its state as a dwelling. In addition to being an exchange, the person selling, i.e. the individual here, must have lived in their old dwelling as their only or main residence during the prior 2 years to the transaction. And they must also intend to live in the new dwelling as their only or main residence after they've bought it. Those kind of concepts, only or main residence, should be kind of passing familiar to people who have watched a couple of our webinars now, as they also crop up in the context of the ADS. There's an additional little restriction here on the availability of the relief, which is that the garden and grounds of the old dwelling can only be so big. They can only be ½ a hectare in size. As soon as you have garden or grounds that exceed that size, then the relief starts to get restricted, and it's restricted effectively to the value or the proportion of the value that you can attribute to the old dwelling and a ½ hectare of grounds. So in other words, the house building company will still pay LBTT on the value of the excess area over that ½ hectare. Property trading companies, they have a slightly different set of reliefs. First of all, they have to be acquiring a seller's old dwelling, and they must be doing that in circumstances where either the seller is buying a new build from a house building company, or in circumstances where the seller has arranged to sell their old dwelling in order to buy a new dwelling, and that sale of the old dwelling has fallen through and the property trading company is stepping in to buy the dwelling and allow the chain to complete. In either case, the purchase has to happen in the course of a business carried on by the property trading company of buying old dwellings in those circumstances. So either to allow people to buy new builds or to complete broken chains. As with the house builders relief, we then have these sort of three kind of restrictions. So number one, only remain residents for the old dwelling. Number two, seller has to intend to live in the new dwelling as their only or main residence. And number three, that half-hectare restriction on the size of garden and grounds. In addition to that, there are a couple of other reliefs and potential points where the relief claimed by a property trading company can be withdrawn. I'm just aware that I said there are a couple of extra reliefs. There are a couple of extra restrictions on the property trading company reliefs. First of all, the property trading companies are capped in the amount they can spend in refurbishing that old dwelling in order to get it ready for sale again. Very roughly, that restriction is 5% of the purchase price that the property trading company paid for the property. That is subject to a lower limit. So no matter how much you paid for the property, you are always entitled to spend at least £10,000, but it's also capped at £20,000. So if you buy property for 400,000, you could spend £20,000 renovating it. If you buy a property for £1 million, you can spend £20,000 renovating it. That threshold there, though, doesn't apply to any expenditure on cleaning or any works necessary to make the property actually safe to inhabit. So, for example, removal of asbestos will not be counted towards that permitted spend. Other two restrictions are that the property trading company, it effectively needs to be intending to sell these old dwellings that they buy. They cannot really lease or license them out except on very short-term 6-month leases or licenses. And they also can't allow connected persons such as directors of the company to occupy the old dwellings that they are acquiring. If the property trading company exceeds the expenditure limits or grants a long lease or license or allows a director to occupy the property, then the relief that property trading company has claimed will be withdrawn. And what's interesting about that is it's not subject necessarily to the same sort of 3-year time limits as other LBTT reliefs are, where they might be subject to withdrawal. So that brings us to the end of the seminar. So we're just going to throw things open for questions for a couple of minutes. I can see a couple of questions that have come in just as we were speaking. The first one I think is for you, Isabel, and someone is asking, can you apply to defer LBTT if you have a lease with uncertain or unascertainable rent?
The answer to that is no, you can't. You can't defer the LBTT in relation to rent, but you could defer LBTT in relation to a premium if the premium was, or if aspects of it were uncertain or contingent. And Revenue Scotland have certainly just accepted one of those that we've submitted. So not on the rent, but yes, on the premium.
Okay. Another question that's come in is, with prudential planning, what happens if you buy a building partway through completion? So the reason someone might buy a building partway through completion as a sort of prudential planning exercise is driven by VAT, first of all. If they are aiming for something called a golden brick transaction, which is a kind of planning you do with residential or quasi residential property. In those circumstances, you want to build out the property to at least the first brick above the foundation level before you sell it on. So you will have some works that have been completed before the sale. And the answer is you have to have a just and reasonable apportionment between land and future works. The way most people deal with this in practice is by including the cost of works undertaken to get you to golden brick, or to get the building to whatever state it is in at the point it is sold, and treat that as part of the land price. Someone has asked, with regard to the new build relief for housing developers and restriction on garden ground, is the garden ground over 0.5 hectare taxed at residential rates or non-residential rates? I think in theory it would be taxed at the residential rates, because residential property is defined as being a dwelling together with its garden and grounds. So if you just had a house with a large plot of land attached to it, then that would probably be residential, because the relief isn't going to change the character of that transaction. However, if you have a much larger property, such as estates, you'd really go back to first principles and look at the subject matter in the round to decide, is this residential or non-residential? The point about the relief is that it talks about dwellings, which is, it looks at specific buildings, whereas the residential or non-residential distinction, you look at the subject matter of the transaction as a whole. So that is a roundabout way of saying it could be either. It depends on what you're buying. If it's just a house with a big garden, though, I would expect that to be residential. Okay, one more question has come in, which is just asking, why are options treated differently to contracts for the purposes of the subsale development relief? Very quickly, it is because in LBTT and SDLT, an option is treated as a right in land itself rather than a contract. So you always kind of have to distinguish between the agreement for an option, which is a contract, and the option itself, which is treated effectively like a right in land. So if you have an agreement for an option, that is one thing, but you don't have an agreement to buy the land until the option itself is exercised.
I think we've probably come to the end of the questions that we've got time for. If you want to get in touch with us after the seminar, please do send an email with any additional questions, and the ones that we haven't had time for, we will get back to you after the webinar if we can, and hope that the webinar has been useful, and please do sign up to receive future communications from us if you haven't done so already. Thanks very much for your attendance today, and we hope that you found this helpful. Thanks a lot. Bye.